So this week we've seen quite a spectacular rally in crude oil prices, which has also been reflected in other risk markets, and of course it's had a massive effect in currency markets, in particular the Canadian dollar, other commodity and risk-oriented currencies, but also sterling, which has rallied from the lows that we saw quite recently. Now, on the surface of it, it may seem that this rally in crude oil has been driven by rumours of OPEC and Russia being willing to reduce crude oil production in order to support prices. And on the surface of it, this seems like quite a good reason for a crude oil rally. However, if we look at the crude oil chart, we'll see that the bottom really is last Thursday when a certain Mario Draghi of the European Central Bank was speaking. So what we could be looking at really is a Draghi effect rally that's driven by sentiment and really a recovery in risk appetite rather than a permanent reversal in crude oil's fortunes. There's any number of things that could cause a reversal in this latest rally and could send crude oil and risk markets tumbling again. The first and probably most important factor is another rout in Chinese equity markets, or some kind of negative economic news from China, which, as we've seen in 2016, can have devastating effects for global risk appetite. In addition to this, we have supply and demand dynamics in the crude oil market, particularly in North America, where it is very clear that there is a supply glut in crude oil that's not dissipating anytime soon. So even though we are seeing a rally in crude oil and risk appetite, it's by no means assured, and probably the most important thing to look out for in February is exactly how risk sentiment develops and if we see another rout.